We've talked quite a bit about the impact of just a robust year from a deal perspective. Would love to get your perspective on what you saw your clients really executing on.
It really was a hard to catch your breath year in 2021. Private equity firms execute on 8,500 transactions for over $1.2 trillion in value last year. That's over 50% higher than the previous record. That was only matched almost by the exit activity that we saw.
Yeah, there was a breadth across industries. It was entries and exits, but it was really across the board. And some industries, of course, are as they've been the last few years, very strong, like healthcare and technology, but really across the industrial spectrum.
The mega funds are becoming more mega. The bigger funds are becoming bigger, and the 25, 30, $35 billion funds, it's no longer aspirational. When it comes to transformative franchise transactions that these private equity firms are looking at, they want to be playing on both ends of the spectrum. They have pools of capital that want to do the buy and build, but by the same token, there's only so many firms that can do those mega deals. And I believe that we're going to see a material increase in north of $10 billion transaction value deals going forward.
You know, one thing that I think is predictable looking forward to 2022, it always takes a new administration about a year to put its people in place. It's now clear that the administration is going to challenge many corporate transactions, and one of the consequences of that is that sponsors in many respects which have lower market share have a bit of a competitive advantage in looking at certain properties, especially with the added capacity to stretch a little bit on size.
Right. Yeah, no, we're certainly seeing it on some of the larger deals we're working on, where I would say the sponsors are just as competitive as the corporates. And I think some of that is the certainty to close. I wonder, your thoughts on, as we look forward, that IPO backlog.
The backlog has, of course, grown. And a lot of companies that had contemplated going public, they're sitting in that queue. No sponsor wants to go into a volatile market where they cannot predict where they're going to price that IPO. And more importantly, where it's going to trade. Over 80% of LPs right now, when they're doing due diligence on funds, have stated that they are now or will soon be evaluating ESG as one of their major differentiating points of where they invest their capital. Now, what's interesting about ESG is there's no standardization across the private equity landscape as to what is ESG. And so we're going to see an evolution over time about how private equity firms are thinking about ESG and how it matters to them, and maybe we'll see dedicated pools of capital.
Yeah, the E in ESG, the environmental investment, we've seen a big upsurge in that, in renewables, in infrastructure, in all sorts of areas that affect the environment, and that's obviously a big focus on us as we help with the energy transition across the board. Obviously, Russia's invasion of Ukraine has an impact on all of us, and first and foremost, we think of the human impact. And then you think about the economic dislocation that comes with that. We've seen commodity markets and energy markets have a tremendous amount of volatility. And then, of course, both of those factors play directly into confidence. And confidence, as Vito and I often talk about, drives M&A activity and investment activity.
We talk often about the regulatory regime in the U.S. We also need to consider that there's a lot of individual regulatory regimes that have popped up around the globe. And if you look at the EU, for example, 24 of the 27 member states now have their own individual regulatory reviews, that if you have exposure in those geographies, it's going to be an additional hurdle that you have to clear. I don't think it prevents deals, it just elongates the timetable.
I'm incredibly optimistic about this year. And it really just comes down to just the overall health of this asset class.
Even if there's a 20% drop off in volume this year, it'll still be the second best year on record.
The sponsors are not paid to sit on cash. And they will find ways, especially in market volatile periods, where they know that if they make the right investment that's on theme, that's consistent with their strategy, that their returns are going to outperform almost any metric.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.